You're 73 years old and you're retired and you've built up $1.5 million in your 401k. The question becomes, should I start the conversion process of moving this tax-deferred money into a Roth account? That's what we're going to look at on today's video. My name is John Vandergriff. I am one of the owners and the wealth planning team lead at Blue Ridge Wealth Planners, where we help people make the transition into retirement effectively, or if they're already there, help them plan for the things that in many cases they don't get planned for. And one of those areas that we find that most people are not talking enough about today is the process of tax planning. And so that's where we're going to focus today, and you're going to start to see some of the importance of that decision, but also the connection that it has with other areas. So before we get started, I want to point out a couple of things. First, if you enjoy this video, want to share it with other people, make sure that you like it, share this video, subscribe to our channel. That way we can get more people in front of the information that we have here and hopefully help as many of them as possible with these type of tax decisions. And then the other thing is more of a disclaimer. We're going to go over some specific things in this video. These are not meant to be exhaustive. If you are wanting to pursue this, I would recommend talking to your CPA, getting all the information that your particular situation has before you go acting on some of the advice that you see in this video. So as we look at this, those two things out of the way, we've got a 73-year-old couple retired with $1.5 million in their 401k. Should they convert to a Roth? And the reason this video is important is because at the end of 2022, the government actually backed up the required minimum distribution age to 73 now. It used to be 72, and then prior to that, it was 70 and a half for a really long time. So as we look at this, a 73-year-old has some challenges if they want to do some Roth conversions. It's not impossible, but we've just got to look at what those challenges are and if this decision makes sense for that particular situation. So as we look at this, and again, you know, in our opinion, in retirement, you need to plan for more than just investments. As you look at this, when we walk through a kind of planning scenario with a couple, there are 5 main areas that we want to look at, not just considering the goals that they have, but what they've done in income, investments, taxes, healthcare, and family legacy. And what you start to see as you go through this discussion is all these things are interconnected. And as we look specifically at taxes today, and really the effect that income will play into that, taxes really have branches into all of these areas, and that's why planning for that and making sure all these pieces together are working together is so important. So as we look at a little bit more of these specifics, so we've got a married couple, both age 73, so this is the start year for them for required minimum distributions. As we look at this, their combined Social Security income is $5,200 a month. And then between them, they've got $1.5 million in their 401k, another $350,000 in the bank, and their income need at this stage is about $80,000 a year to make retirement function. So again, we'll look at how this plays out and how much of this is taxable once we get to our planning sheet, but we do want to point out why Roth conversions are a little different once you reach required minimum distribution age. So you still are able to convert to a Roth, but when you age into required minimum distributions, you actually have to satisfy your RMD first before you do any type of Roth conversions, and you actually do those basically on top of the required minimum distribution amount. And unfortunately, your required minimum distributions are not eligible to be placed inside of a Roth account. You know, it would make sense if you're forced to pay the tax, which again typically happens when you have a Roth or a Roth conversion that takes place. Because the government is requiring you to take this money out, that's a scenario where you don't have the option to place those particular dollars in to the Roth account. You could do anything on top of it, and you could actually use some of your RMD to pay the taxes on that Roth conversion. So we'll look at some of those scenarios here, but it's important to realize that you still do have the option to Roth convert when you get to RMD age. We just have to look at the numbers and say, is it worth it for this particular situation? So as we look at this, I'm going to zoom in. I've already done a little bit of the prep work here. So with this couple needing $80,000 a year, what they've been doing prior to this for retirement is obviously we see their Social Security income sources there. That totals $62,400. So really they needed a little less than $1,800 or $18,000 a year, about $1,500 a month from their investments. But when they get to this year, the government is going to step in, and based on the divisor at 73, they're actually required to take out $54,744, which is about 3 times the amount of income that they were taking from their investment portfolio. So as we look at it, they're used to having an annual income of $80,000, but really they're going to be in a position where they're actually going to have to take out $54,000 on top of this. So their taxable income would be, it's a little less than the $116,000 that you're looking at, because the way Social Security is taxed, this is at most 85% taxable. So this 62 number is really like 53, somewhere in that range. But as we look at this, even with that factored into their Social Security income, their top tax rate today is at 12% based on the brackets that we exist now. So we're going to look at why that's important in a second. But then also we want to see, based on the way that their taxable accounts are, there are 3 main tax buckets for your investments. We've got pre-tax monies at $1.5 million, after tax at $350,000, and zero monies in tax-free accounts like Roth IRAs or properly structured life insurance that gives tax-free benefits to those that implement it properly. So this is not unusual. Most retirees that we look at will actually have a majority of their money in pre-tax monies, and the goal, if now is the time for them to pay the lowest taxes, is start migrating these monies down so that they can get more money that is after tax or tax-free, so that they know what they have, that it's not exposed to if the government raises tax brackets and puts them in a worse off position. So as we look at this, we have to look at where taxes are now, but also where they could be in the future to determine if now is the time to start looking at Roth conversion. So again, today we said 12%, and this shows married couple with standard deductions today. So if we look at the top of each of these brackets, the 12% bracket would actually top out at $117,000. They're firmly in there today. Even after adding their RMD to it, they're still actually within the 12% bracket. So as we look at this, I want to look at 2 numbers here. The first one, this says 2017's tax brackets, and you say, well, John, why are we looking backwards? Well, again, we don't know what the future will hold with tax brackets, but the current tax code that we have today is set to expire after the tax year 2025, and if that does happen that way, the brackets would revert back to the way they were in 2017. So effectively, you could really call this 2017 or potentially 2026's tax bracket. So as we look at that, again, with them at $52,000 of income before RMDs are factored in, they're firmly in the 15% bracket, not the 12%. And if you added their RMD on top of it, their conversion at this time would actually start at 25%, because their total would be a little over $105,000 when you take into consideration the RMD and their taxable income. So again, 15 or 25 is a lot more than 12%. As it is today. The reason I'm bringing up this last number, 1981, is because this was the last time that we had noticeably higher taxes than we've gotten used to over the last several decades. And so, as we look at this, for this couple, their starting tax, as you see here, at $52,000 would start in the 21% bracket instead of the 12%. If you notice, going back a couple slides here, our top tax bracket today is 37%. You go to the top tax bracket at this time was 70%, which is almost double. Well, they're almost double with their starting bracket today. And if you factored RMDs on top of it, their income being about $107,000 would actually put them into the 37% tax bracket if they were wanting to take out monies and look at maybe doing a conversion later. So as we look at this, the thing that we have to be aware of in this discussion, and this is where I have a lot of conversations with people about, planning options, what should they do today versus, should they not do when we look at this, is we look at this and say, okay, well, if I've got money in a 401k Let's say we've got $100,000. The question becomes, should I leave this alone or should I take this money out and do something else with it based on the tax environment that we are in today? And so what we've got to do here is we've got to look at the tax environment now, but also what that tax environment could be later to make the best decision possible. And again, when we have this, I share this example with a lot of financial advisors because a lot of people in this industry have not been trained properly when it comes to this discussion and what is in the best interest of the client. And so we're going to look at this example and see what things we need to factor in. So if we leave money in a 401k, there is no tax impact today, although this couple at 73 will have to take some money out. It's just a question of, is now the lowest time, or are they going to be in a position where that will be higher for them later? But again, looking at this stock scenario, we're assuming just leaving the money alone versus if we took that money out. If we did that, whatever amount comes out of the 401k or IRA is going to be taxable in that tax year and trigger a taxable event. So let's say in this scenario, the tax event was 20%. That means that net of taxes, they would have $80,000 left. We could actually pay the taxes out of another bucket, but to make this example where we're truly focused on the taxes, this helps because you would actually kind of cheat better toward the Roth if you didn't have to pay the taxes out of this money. So again, we want to look at this as a fair example. So some advisors will actually stop you right here and say, this is why a Roth conversion is bad for you, because in this scenario, you've got 100,000 versus 80. If the market or what you invest in goes up, let's say 10%, this is going to make 10,000, this is going to make 8. So again, you're making less money in the Roth. Why would you want to do that? And typically that's enough for people not to pay attention or do something else. But we've got to play this out because we're not in equivalent buckets. This is now a tax-free bucket as long as it's in place for 5 years. This is now still a fully taxable bucket. So we've got to see in the future, is that decision the wise decision for this particular couple? So again, to factor in some things that are equivalent, we want to keep our growth rate the same, assuming these investments are the same. We also want to look at it from a standpoint of it's the same length of time. That way we take care of time value money, inflation. Again, we're just focused on the tax discussion here. So assuming the Roth has been in place for 5 years, in this scenario, the entire bucket is actually tax-free for this particular person to take out as much as they want to. Doesn't matter, it will not trigger a taxable event. The IRA is not that way. It does depend on what the taxes are at the time you take the money. So if the tax environment at the end here is the same as the beginning, what I want you to notice here is looking at the bottom line, the numbers are exactly the same. 160 versus 160. So if taxes never changed, it actually doesn't matter which of these decisions you make, whether you leave it in a 401k, you take it and put it in a Roth, you're going to get the same impact no matter what. Now, when we look at the way that we have been taught to plan for retirement, most people will look at this scenario and they'll say, oh, well, don't pay taxes while you're working. Wait until retirement, pay taxes on this money at that time, because if you have lower income, you would have lower taxes. And so if we look at that scenario and that did in fact happen, let's say your taxes went down from 20% to 10%, you would actually have more money in the 401k, even though this bucket's been growing tax-free, because the tax rate you paid here was lower than the tax rate it started, or kind of the cost of getting into the tax-free bucket. Now, even though that makes logical sense, I don't know if that's going to be the scenario that we have, because no one has ever promised you if you show a lower income, you will pay a lower percentage of tax. We've seen over our history of income taxes that tax rates have been much higher than what we enjoy today. And so when you combine that with the overspending that's happening in Washington, with a massive amount of debt, over $31 trillion, I think very high scenario that taxes will go up. And if that's the case, we have to look at the direct impact that this has on these monies, because as we said, the Roth is not impacted. You've already paid the tax bill, it's done. The IRA though is 100% exposed, or 401k. So if 30% is the tax bill, you now have less money by doing nothing. So that's not what we want to happen for people, especially if we feel like now is the lowest environment. But the two factors we do not know today is when will the tax brackets officially change, and when they do, and in my opinion, if they go up, how high will they go? How much will that impact? We don't know the answers to those, so we have to look at history and the things that we've done in the past to make some educated decisions today and trying to help you pay the least amount of tax. So as we look at it today, 12% is where you would make either decision. And I've got two numbers here because we're looking at, this is the tax bracket for the Social Security income only. So where the RMDs would start, or IRA distributions. This is factoring in the RMD distribution. And there's two numbers here, mainly because the 12% bracket covers both scenarios today. So again, 12% would be your starting bucket of conversion now. If we look at what the rates would be in 2017 or 2026, 15% would be where any IRA distribution would come out, so that is higher. If we do something on top of what the government makes us take, 25% is actually the cost, so noticeably higher. And then as we said here, 21% would be the starting distribution rate on RMDs, and then after the RMDs are considered 37%. So as we look at this, I see this scenario, this tells me that it is in the best interest of the client to start pulling money out. It's just a question of how much. And again, it depends on how aggressive you want to be. So as we said, we factored in the taxable income, Social Security, $53,000 and change, the RMD at $54,744. That puts you at a little less than $108,000 of taxable income. So if we wanted to maximize these buckets, and this is basically the amount that would be in that bracket, the percentage, and then this is actually the tax dollar, 12% or $1,100. As you see here, this is the total tax. That effective rate is 22.9%. If we maxed it out all the way to the top of the 24% bracket, which again, still pays the tax at a lower rate than 25%, going back to our previous page here, where RMDs would end at, I still think that's a good decision for the client. That would be $284,000 of conversion that happens. You actually get a double benefit there because not only are you converting 284, you're lowering the bucket that you have to take RMDs from by $284,000, as well as the RMD of 54. So that $1.5 million that this couple has actually shrinks below 1.2 in this scenario, assuming no growth on it. Obviously growth rates can change that, but that would decrease the amount of RMD that they would have the next year moving forward. And again, just help them lower the impact of that taxable distribution and hopefully pay the taxes as little as possible. Now, we can't have this discussion without addressing anybody the age of 63 or older is going to have an impact to Medicare if they do large conversions. So again, if we take a client above $194,000 of taxable income, it will increase the amount of Medicare Part B premiums that they pay up to, an infinite number. But in the scenarios that we just looked at, we would be in a position where at most it could add $8,700 2 years after they make that decision. And the key with this, you've just got to add whatever this total is to the effective tax rate to see if it's still a good deal for you. And again, we've got a pretty good buffer there. I don't see a scenario where adding this $87,000 is going to push you into, I think you still may be less than 25% or around that number. But again, you don't have to convert this much. We're just looking at it for the tax bracket. So again, there's a lot of factors that are at play here. That's why we say at the beginning of the video, don't make your decision just like this one. If your situation looks very much like this, there could be some things going on for you specifically that could differ from what we're looking at. But if no one has had at least this much of a discussion with you about tax planning, the reality is they probably don't work in that area, or they're never going to have that tax discussion with you. And again, this is a super important thing. Even if the move is to do nothing, you need to be talking to somebody now so that we don't miss an opportunity to potentially pay the lowest tax brackets that you ever could see again. So as you look, we've got a link as a part of the video here. If you click that, that will get you onto our calendar where you can set a time to talk to one of our wealth planners, see if this discussion makes sense. And again, if it does, we can help you go down the line, help you in some of these areas the way we do our clients, or if nothing else, we just have some discussion so that you can understand this a little bit better. So hopefully you enjoyed our video today. As I said, make sure that you like, share, subscribe to our channel here. If you think this would be of interest to somebody else, again, tell them about it, have them log on here. We're going to do all we can to help people with these type of discussions. And until next time, hopefully you enjoy this and our other videos.